Wow, what a day yesterday. Let's first off start off with the morning reading from, various headlines that I've cobbled together. Global stocks tumble on Greek crisis. Europe and Asia lead foreign markets lower. Technical damage is done to US market. Dow Industrials fall below the 200-day average. S&P 500 falls to the 3-month low. The FTSE All World Index breaks trendline support, raising risk for the global stocks. Let's drill down a little bit more. Global stocks tumbled today. EFA falling 3% to the lowest level in nearly 3 months in very heavy trading. European stocks lost 4% on average, with Germany falling 3.5%. Asian stocks tumbled as well, including Japan down 2.8 and China down 3.3. Emerging markets, EEM, falling more than 2% to the lowest level since March. That set a gloomy tone for the U.S. stock, which followed foreign stocks lower. The dollar lost round, which gave boost to the gold. Crude oil prices fell sharply. Treasury bond yields fell as a flight to safety boosted bond prices. All U.S. market sectors ended in the red, with the bond price keeping the utility losses small. Although the main catalyst for today's sell-off is Greece, negative divergences in the U.S. stock market, like downtrends and transports and utilities, left it vulnerable to a downside correction. Drill down a little bit more. Market indexes break down. Stocks had their worst day of the year. Dow Industrials losing 350 points, down 1.9, and ending the day below its 200-day moving average. That's the first drop below the long-term support line since October. The S&P 500 lost 2% and fell to the lowest level in 3 months. That puts the S&P in position to threaten its 200-day line. The NASDAQ composite knifed below its 50-day line in heavy trading. Small caps also fell sharply. If you take a look at the NASDAQ specifically, suffered a shock day on Monday, a 3 standard deviation move coming on the heels of a 52-week high. Such abrupt changes in market structure have coincided with important peaks in 2000 and 2007, but was not consistent prior to that. On the All World, FTSE All World Index turned down, closing the lowest level in nearly 3 months. It has also fallen below the rising support line, extending all the way back to last October. The FAW is now headed for a test of the 200-day moving average. Global stocks were in need of a correction, and Greece certainly provided the catalyst. The collapse in Chinese stocks, which had been the world's strongest market, may have also contributed to the global doom. A more defensive posture is warranted until the dust settles. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:20 a.m. Central Time, and I'm recording this in preparation for the market day of June the 30th, 2015. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's dive in. Let's take a look first off at a couple charts. On the SPX, I drew a fib retracement here, and notice that if you anchor to the February swing low, to the recent all-time highs, that yesterday's action coincided right at a close on the 50% retracement. The next key line of support would likely be this confluence area where you have a 618 fib extension along with this important swing area. Now, yesterday's action was super important. You went from what was a trading range, but still in an overall pattern of long-term and intermediate-term bull, to breaking through diagonal support, breaking through horizontal support, breaking out of the multi-month trading range. You could argue that we are still in the larger trading range that's incorporated by the February low and the recent highs, and we're just 2/3, 3/4 the way down through the bottom of that trading range. But clearly, you had a pretty nice trend line here. You had touch, 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 near touch, near touch. A pretty good diagonal support line coming through this area. And while these both violated, they both came down to a horizontal support. And generally, you consider horizontal support more important than diagonal support. But still, knife through that, knife through the horizontal support of the near-term range action that had gone back all the way until about the first week of April, to come all the way down to this point here. Now you had in the S&P an over 3 standard deviation move. The Russell was a 3.5 standard deviation move. The Dow a 2.6 standard deviation move, and then the NASDAQ, of course, right at a 3 standard deviation move yesterday. So these were really big moves, and statistically, these kinds of moves aren't meant to be seen, but in probably several hundred trading days on normal distribution patterns. Now, this was for the S&P the biggest down day in 2015. Other things to keep in mind about this is we had on our own system an increase in the hedge risk level, going into Monday from 0 plus to 1, and then just one day later we go from 1 to 2. And we'll talk more about that, but still pretty significant increase in risk levels in a very short period of time. Also, of note is that with the S&P and the Dow, they are now both below their January open for 2015. So for those buy and hold traders who have been sitting in their positions throughout all of this, they have absolutely nothing to show for their performance for the first 6 months of this year. Obviously, you got one more trading day before the first 6 months is closed, but not great for the buy and hold crowd. In terms of our morning report, overnight action was stronger, and indeed, we've got a number of factors coming together. Not is it just news from Greece this week, but you have today the end of the quarter and the end of the first 6-month period. You have a seasonality impact from the 1st of July, and then also the 4th of July week, and we have a short trading week this week as well. So a lot of cross currents coming together. Overnight action last night in the U.S. broad market indices, though, in general up about 0.5%, with the S&P being the strongest at 0.55 and the NASDAQ being the weakest at an increase of 0.41 at the time of this cut. You had crude oil up also about 0.5%, euro down about almost 2/3%, bonds scratch, and gold down just marginally about 0.2%. Look at the overseas action though. China had taken it on the chin yesterday, but up huge today, up 5.5% so far. Hong Kong up over 1%, Japan up about 2/3%, Germany marginally up, and United Kingdom, the only weak one in the group, at down about 1/3%. In terms of macroeconomic reports, we've got a big slate for today. In fact, all I could fit on the sheet here was Tuesday's. But bottom line, you have a situation where a lot of world information coming in today. U.S. specifically, you got Chicago PMI and consumer confidence. And that looks to be it specifically for the U.S. In terms of our volatility, obviously big increase in volatility yesterday. We have the short-term VIX up over 20 at a 22.56. And look at these IV percentiles. Now, these are not high numbers in terms of historic proportion, but they're certainly a lot higher than we've seen in quite a few trading days, perhaps weeks, with the S&P at a 55, the Russell at a 50, the NASDAQ at a 53, and then the Dow actually, in the upper quartiles at a 75. And you see the standard deviation moves that were put in yesterday, and actually, having 1 or more standard deviation moves in a 2-week period is right at normal. but certainly this is pretty extreme here with the 3 that was put in for the S&P just yesterday. In terms of our regular daily report, a lot of change here today. First of all, note that the intermediate term phase opinion has broken down to a phase 5, and that's described as the break of diagonal and horizontal support. There's a lot of different traits to that, and members, you can certainly go into the charts to read about the characteristics of this phase. I won't spend time in this video today, but bottom line is the kind of takeaway description to that is the break of diagonal and horizontal support. So not a good place to be for the bulls. IBD status is still uptrend under pressure, and our accumulation distribution on the charts, S&P is an E, NASDAQ is a D, also not very good. GMI index fell all the way to a 2 out of 6, and our intermediate term market posture is now very bearish. So not very good there. In fact, we'll go ahead and take a look at that. S&P, you see, falling below the 50 line into the very bearish category. Dow also below the 50 line at a 35.5. NASDAQ is bearish, but not as bearish as the S&P and Dow at a 62. And then Russell is the one that has held up the best, and is at a 72.1. In terms of position sizing opinions, you had with the increase in hedge risk level to level 1 yesterday a drop in the portfolio investor position sizing opinion to 50%. With yesterday's action, the VIX moved up over 19, and that now has the active trader posture taking a position size in the 50 to 75% range. So at both systems of opinions in determining position sizing have certainly dropped here in the last 1 and 2 trading days, so that's also a warning for you. In terms of hedge warning status, back-to-back days we've gone to a new level now, a risk level 2, which is called the red light. And note that in 2015 up to this most recent run where we had our 0+ go for 30 trading days. Prior to that, we'd only had a kind of all clear for the bulls to take and initiate new positions that had lasted like 2 days and 5 days and 12 days before failure. Well, in this case, we went 30 days, but during those 30 days we really accomplished very little. We had a period of time where the S&P broke out of its prior range, this breakout candle right here, followed by 2 inside days, and then one with an intraday high that established a new high and a new closing high. But this was the Thursday before the Memorial Day weekend, so very low volume, not a lot of participation, followed by an inside day. And then guess what happens on the first trading day after everybody comes back? Total rejection of that breakout, and thus failure to break out that range, and then right back into the prior range. So if you look at the 30 trading days that comprise this most recent hedge risk level 0+, it accomplished nothing. So 2015 has been very, very difficult for the buy and hold crowd, for the long only crowd. It has been much more favorable to those who are much more nimble and able to trade ranges, do option income strategies, or if you're a swing trader, at very least being able to do two-sided action and go for shorter targets and less risk whenever possible. So yes, we've broken from 0+ back to red light with this most recent breakdown, but this last one we remained very cautious throughout that entire trading period, and had quite a few cautionary statements. I'm not sure just where to put this, but we certainly during this entire period had fewer put sales, for example, a lot less swing trading going on. We were much less active during this period than we would normally be in a hedge risk level of a 0 plus or a 0. And it was all because we were seeing these multiple warnings coming in that we're talking about. Now, obviously, right now, we're seeing much more. And let's break this down a little bit more. In terms of the volatility warnings, quite a few of them. The market in decline warning flashed, as did the sharp increase warning. We have a VIX spike present. We also have the VIX over 18, and the VIX daily squeeze has fired as of yesterday long. So obviously it fired not even just out of the daily squeeze but into a full-fledged spike. So you basically went from almost complacent to extreme all in one day. Now, many times you'll see from those VIX spikes a fade back, and that might mean we might see something of a bounce in the market. Obviously, this is being very much driven by a news event, and the news is not over. This is not the situation where there's a release of news, the market digests it, and then moves on. In this case, with the Greece situation, the news is not over, and we're likely to see continued volatility as more news develops along that situation. Distribution day count very high. S&P at 8, NASDAQ at 6. We have a volatility ratio warning. We have the VIX phase climbing. Skew was not extreme. So that's one thing to take note of, that there's not expected, based on the skew indicator, to be significant near-term weakness. So while yesterday was big, it's not really painting an expectation that we're going to see another 40-point drop today. In terms of new highs, new lows, obviously very ugly day at the New York Stock Exchange with 754 new lows put in yesterday for the month. In terms of the E-mini chart, we had flushing patterns show up on the Dow, so that may in particular be setting up for some bouncing action. Obviously, we'll wait to see what the news does to help drive that. This was another one prior to yesterday. The intermarket risk aversion indicators, all 5 of those were flagging off. So we had a number of warnings prior to yesterday that the market was unstable. In terms of the special opinions, some changes here for today as well. In terms of option income strategies, the VIX is now outside the acceptable window. Novice traders should not initiate new positions in the current market environment until that VIX comes back down to below an 18. More aggressive traders, obviously, you've got to take into account not just the increased volatility, but what that means for your strategy selection and placement and so forth. So just kind of take that into account for those option income strategies. Covered call strategies, novice traders should probably not initiate new positions, and that's the opinion there. Aggressive traders should use a one-to-one distribution between in-the-money and out-of-the-money strikes, and put selling conditions are not acceptable for new core put portfolio positions. Aggressive traders should consider put credit spreads with defined risk, and consider scaling into positions if you are probing bottoms in some of your favorite stocks, particularly stocks and positions that you are willing to own, and taking in a position size that is in alignment with what you are willing to accept assignment at, until that market has a more broad bullish posture. So in terms of sector specific, obviously a sea of red came in both on the short and intermediate terms, and quite a bit into the long term across all the sectors. There are no healthy sectors at this point. In terms of wow, look at this. I mean, in terms of percent change, it's not just yesterday, and we've been talking about this in recent trading days. It's not just the short term, but look at this: the 5-day, the 1 month, the 3 month, the 1 year, the year to date. I mean, for many of these sectors, this sea of red goes back for a pronounced amount of time. So very difficult to be able to say with a straight face that we've been in a long-term bullish stance when you go back all the way to year to date and have negative returns in half of the sectors. Obviously, utilities being the most down for this year, down 12%, but many of these other sectors have certainly not provided any kind of returns, and only two sectors on the year to date, consumer discretionary and healthcare, have provided any kind of significant return since January the 1st. Okay, that should be enough for today. As always, if you found us on YouTube, that you like us, is greatly appreciated. If you found us through Twitter, retweet us to your followers. Always appreciate it there as well. If you have comments or other suggestions, the email address support@falconglobaltraders.com. Always commentary is welcome. More information about how we apply this into our daily trading can be found at this website. Performance matters. We get that. We're very transparent with modeling from entry, adjustments, all the way to the end of the trade, each of our trades. And you see we have trade journals and the like. At the model position size, this is the performance year to date. In terms of, obviously, free trials are available. Disclaimers as always. Hit the pause button to review these if you need more time. And as always, we greatly appreciate you each and every trading day. We'll see you back here for the market preview before the market open tomorrow morning.